A lot of trading updates over the last couple of weeks. We've more or less got the retail sector of the JSE out the way. Banks are starting to come through now, and African Bank Investments Limited came out with its quarterly trading update. Now, the December quarter is traditionally the strongest quarter for an organisation like Abil. It's done quite well. The share price is outperforming this morning. Actually, it's up 0.7%, and that's against a flat JSE. Here's how they start their trading update. It says the following. It says trading conditions in both the unsecured lending and furniture industry remain challenging during the period, and the whole trading update is sort of peppered with caution and conciliatory words towards regulators and the government. On the line now from Sanlam Investment Management, SIM, in Cape Town, is Patrice Rassou. Patrice, as I said, normally the strongest quarter, the December quarter. What did you make of the numbers in general terms, first of all?
Look, I think, Binza, you summarized it quite well. I think that we have been expecting a bit of a pullback in terms of the level of credit growth, and that's exactly what we're seeing in the numbers. The credit disbursements are flat year on year, and you have to remember this is a market which has been growing at 40% per annum. So already African Bank are talking about a halving of the run rate of unsecured lending growth from the 40% to 20% for the coming year. So we're seeing basically that sort of exuberance really being taken out of the market.
Do you think it's because of initiatives from the lenders themselves? In other words, saying, well, wait a second, this is getting a little bit out of hand and this could have implications for impairments in the future? Or is it because the demand is simply not there because there's been such robust demand in the last couple of years?
What's quite interesting in terms of, if you look at their trading update, is they talk about the number of applications being down 7%. So there seems to be a bit of debt fatigue as well, whereby there's been so much credit being poured into this market that it seems that the capacity to take on new debt has been reduced. And on the other hand, part of the portfolio has been impacted by the various strikes in the mining sector, in the agricultural sector, which means that labor unrest has made some of the lending also a bit more tricky. And African Bank talks about increasing impairments as a result of that as well. And then finally, on the retail side, you have to remember they've got a furniture business, so they're not a pure lending business as such, and the trends that you've spoken about in the retail sector are definitely coming through. We're seeing retail sales down 8%, so there's definitely a slowdown in terms of durable goods sale, furniture sales being down, as we've seen elsewhere with the lack of Lewis.
Yes, exactly. I think of all the sectors of the retail industry, it's the furniture side and the durable side that has been the most under pressure. They've got Ellerins, they've got Furniture City, they've got a Dial Bed, none of them particularly covering themselves in glory. But I just want to look at a slightly bigger picture here, if I can, Patrice. We had the private sector credit extension numbers coming out today, where we saw growth in credit at 10.1% year on year during the month of December, the best we've seen, or the worst, whichever way you want to look at it, since December early 2009. And at the same time, we've got these credit providers like Abil and even Bayport Financial Services, which also have recently come out with some numbers which didn't look too good. So at some stage, those PSE numbers are going to follow, surely, the tightening of the reins at the lenders.
Yeah, I think very much so. I think a good indicator of that is the fact that if you look at general sort of consumer demand, that's been it's been slowing. You just have to look at the like-for-likes that have been reported by the retailers. When we're talking, 6-7%, with inflation approaching 4-5, you just realize that volume growths are sort of negligible, if at all. We're not seeing any volume growth, which means that the consumer is pulling their horns in, and at the same time you have an environment of austerity whereby, yes, you might get in some cases higher wage settlements, but there's job losses. So it's not as if the consumer out there will have a situation where they'll get much higher real disposable income going forward. So I think it's getting trickier in the retail space, definitely.
It's getting very tricky, and as well, I mean, this isn't to do with this with Abil, of course, but it's very much linked, and that was the cash build trading update. You probably don't cover that, but you know as well as I do that this has been one of the most extraordinary retail stories in South Africa over the last decade or so, and it's been a punter's favourite for so long. And suddenly, it's not grinding to a halt, but it's certainly not achieving the sort of growth that we've been used to. And that also says to me, as a cash business, that what you said is quite true. Debt fatigue may be coming into play there as well.
Yeah, look, I mean, we've seen there's a number of data points we've had more recently. Mr. Price, in terms of like-for-like volumes, looked to have been sort of close to negative. Even Woolies Clothing, like-for-like volumes, very low single digits. So, yes, you know, in the past there's been this great combination of, you know, massive space growth, inflation, great volumes. You know, and as you start to now, all these companies starting to be a lot more cautious, and they're starting to realize that you just don't have an infinite pool of consumers out there who are willing to spend increasingly more for things like clothing, furniture, and the like. So, you know, all these things can turn very quickly. You just have a base effect which is too high for you to grow on year in, year out. And I think that's what's catching up with a lot of these companies, a very high base.
Implications for the JSE, you've sort of hinted at it perhaps, that certain retailers will suffer more than others. Implications for the South African Reserve Bank, what do you think?
Yeah, on the one hand, I think it's in terms of the JSE, as you know, many of these retailers were by and large owned to a large extent by foreign investors who believe the story, and with high levels of foreign ownership, you run the risk that these guys run for the door. You know, if you take with that a bit of increase in risk aversion and a weaker rand, they might decide to cash in their chips. They've done very well in the past year, in some cases 40-50% return. They might cash in their chips. For the Reserve Bank, obviously, you know, there was a risk that, you know, with inflation ticking up, they might hike interest rates. They might want to wait and see if the economy is going to slow down by itself. You know, that might mean lower interest rates for longer. We'll see there.